All right, dude. What's going on, everyone? I hope everyone's having a good start to the week here. I know, Kyle, we're getting started right now. So today we're going to have a pretty special live. I thought we would take a second to talk about earnings season because we're just really starting to get into the heat of it right now. And earnings has been something that, for Jordan and I, it's been a bread and butter strategy for the last few years. And we thought we'd come on and share with you guys what we are going to be, talking about. Sorry, I'm getting thrown off by Kyle here. It's so funny. He's laughing at how it says earnings season in the back there. Yeah, we're going to be talking about our strategy. We're going to be talking about what we're going to be looking at for this earnings season, some of the factors that we take into consideration, why people should be trading earnings, right? A lot of us here, we don't really have any, market makers on the live stream or, people of that nature. So why should you, as a smaller trader, be looking at earnings, right? So I think number one, Jordan, let's just talk about why earnings is exciting. Why should people be looking at earnings?
Yeah. The reason why we love earnings really is because you get about 200 to 500 events happening in a quarter that are diversified.
What do you mean?
Right? So, if Apple has a big blowout on earnings, it doesn't mean that Microsoft is going to have a big blowout on earnings, right? So we actually get to diversify, find a small edge and find diversified bets. And that's that's so important when it comes to trading.
Yeah, you're right. It's like if you find something about earnings that gives you an edge, right? Like a general concept about earnings that can be applied to all these events, you're able to take that small advantage you have and spread it across a lot of different trades. It's sort of like having a whole bunch of different roulette tables in a casino, right? One table can be losing, but at the same time you have 20 other tables going on. It's not like all these tables are going to be losing, right? And you can sort of net out your small advantage, allow that expected value to show itself.
Exactly. It's like, when people, let's say, sell volatility on, let's say, S&P and they sell volatility on Microsoft and, let's say, Apple, well, that's usually one big bet, right? If the market goes down, Microsoft's going down and so is Apple. So you're really just short one big bet. But with these earnings trades, you're going to get a whole bunch of these diversified bets. So what we love about this earnings season is you just need to find a really small edge and let the odds play out.
Exactly. So, but here's the thing, right? I feel like earnings is something that should be exciting. More people should be looking at it. Yet every single hype guru online, every single YouTube person says, hey, don't trade earnings. Trading earnings is gambling.
Yeah.
Why would it be that all of these people are saying earnings is gambling, yet we're sitting here saying there's huge edge and everybody with a small or medium-sized account should be at least looking at earnings as a potential strategy?
Yeah, or even learning from earnings. So I would say
True.
They really think it's gambling because of the volatility, right? You might, let's say, buy a call option, and then tomorrow the stock goes down and your call and implied volatility drops and your option becomes worthless. Also, it is important to keep in mind that retail traders are usually long options. And being long options doesn't usually give a good return on average across a lot of the earnings, just because volatility is usually overpriced. So on average, if these, and because it's a one-day event, these traders are going to be losing a lot faster, right? And so to them, it feels like gambling. At least, when volatility is a bit lower and, there's not going to be a sudden crush in implied vol, and I'm long these options, well, at least I'm going to be able to stay at the casino a bit longer before I lose all my money. So it might not seem like gambling.
It's sort of like a slow bleed out, and death by 1,000 cuts, whereas earnings can be, death by
Tomorrow.
Yeah, tomorrow.
Exactly.
That's really funny. Okay, I think that makes a lot of sense, right? And in the end of the day, when we're saying earnings is exciting, it's not like we're saying go out and just blindly sell vol on earnings, right? In the end of the day, building out a good strategy, right? This earnings strategy that we're going to be delving into a bit today is it's not something that was developed in like 1 second. It's not like obvious necessarily, and that means that it's you have to be good to be able to find it. right? You have to, have some skills, have the data on your side to go out and find where something might be actually overpriced, right? Just because options are on average overpriced around earnings doesn't mean they're always overpriced around earnings. You need to be, and like you can see the guys in the chat here joking about CRM and these stocks that have these huge moves, and the reason they're doing that is these things do happen around earnings. We're not saying that these things don't happen, but we're trying to filter out the ones that it's most likely to happen on, and then sell vol on the ones that are remaining.
Yeah, I was even just seeing my friend Ned there talking about death by CRM, right? It's like even on the short vol side,
one day can hurt.
One day can really burn, right? And that's what actually keeps a lot of traders out of selling volatility around these events.
But that's actually also what makes it worth doing.
Yes.
Right? In the end of the day, selling vol around earnings is almost like you're providing a service to the market. Right? There's all these people who want long vol going into these earnings events. They want to be able to get exposure to that, 5 standard deviation move, that stock doubling in price tomorrow. But who's there selling that? Well, we know that it's not a hedge fund. They can't take on that kind of risk exposure, right? Most retail traders don't have the permissions to be short vol, selling options naked. So who the hell is selling these things, right?
It's usually just Kyle.
It's usually just Kyle.
Yeah.
Kyle and Hutch.
Yeah. And that's the thing, right? There's definitely a supply-demand imbalance when it comes to who's providing liquidity versus who's taking liquidity. And so that really, gives us an opportunity to come in there and start, selling vol around earnings. But like Sean was saying, right, it's not always underpriced or overpriced, right? There are times where vol is underpriced, and we might not be able to see it because there might be some insider information that's priced into that implied vol.
Mm-hmm. So what are some, before we get into exactly what we're doing, what are some like if you were to say 2 or 3 things to keep in mind when you're trading earnings, right? Like for everyone who looks at earnings events, what are 2 or 3 pieces of advice that you would give to them?
Yeah, so just because we've seen a lot of our members do it, and learning from over the years, and also learning from their experiences as well. The first thing I would say is you don't want to overbet, right? You can't overbet with these trades just because the volatility is huge on a given day, right? So
play small, manage your risk appropriately. Don't be putting 20% of your account on the line on one trade.
Yeah, and we're not gonna get complex here, but for the guys that are in our group that are on the live here, when we did that video on volatility at synthetic time, right?
Mm-hmm.
Trading when this volatility gets crushed, it's equivalent to if you're holding a long dated option, right? So, your P&L is going to be huge on the one day. So that's what I would say. First, trade small. And then the second thing I would say is that I've learned a lot from working with our guys here is that you got to really pay attention to slippage and buying those wings, right? If you're short, let's say you're short an iron condor, you got to really pay attention to those wings that you're picking up. And I'm those are probably the most expensive options on the whole chain. And so for that reason, when we're going to be trading earnings this season, I'm going to actually be
no wings.
No wings. Drop size, cut the wings.
Wow. And we're actually going to be keeping a trade journal of it.
Yes.
Which should be pretty fun. So over the next few weeks, these morning lives that we do, we're going to be looking at earnings for a lot of it. Obviously we'll be looking at non-earnings things too, but we'll be tracking our we'll be taking the earnings trades and tracking it in a trade journal, sharing the screenshots of the fills, things like that. So it should be pretty fun. It'll be like a small account challenge, like a 20K account. Let's see what we can do in one earnings season with it. If we YOLO the account on CRM earnings. CRM burned us the last 2 earnings season. What are the odds it burns us 3 times, right?
Funny enough, actually, I was reading an article yesterday where it was the best. So from October to December, it was the #1 season for short option sellers.
Really?
Yeah. Apparently, on average, an at-the-money straddle lost 30% of its value.
You're kidding me.
Yes. So, and one thing that I'm thinking of is because of this huge influx of retail traders. Mm-hmm. So one of the things that we're going to be looking for when we're selling the vol is it's got to be hyped.
Yeah,
Right.
that's actually one of the factors we're going to be looking at this time.
100%.
How are you going to measure that?
I'm going to measure that through option volume. So on our brand new terminal coming out, we have option volume.
Like historical option volume.
Historical call and put option volume. So we
Graphed out.
Graphed out. So we can see, where vol's picking up, or volume's picking up, I have to say. And then we're also going to couple that with some filters on some social media platforms to see, okay, is this volume being driven by retail? And that's what we're really going to be looking for. We're really going to be trying to figure out who's on the other side of our trade, who our client is, and we're going to be taking it from
So
there.
sort of a combination of like volume, overpriced vol, hype on stock puts, for example.
Yes, and of course, we want to see an implied move greater than an average move, and then we're also going to, leak in some more fancy trades like, pre-releases and maybe some 1-3-2 flies into serious call skew or put skew, whatever it may be. But that's basically how we're going to trade this earnings season.
Yeah. Hey guys, we're going to continue this earnings conversation right now, but I wanted to just say this is the most viewers we've ever had on a live. We have 39 people watching right now.
Wow.
If you're enjoying this conversation, please make sure to subscribe and like the video. We really want these YouTube algo gods to be kind to PA, so your help is always appreciated. But back to talking about earnings. Where do you think like the real edge in earnings trading is found? Like what do people need to be looking at when they're like going into an event, right? Without giving away all the secret sauce.
Yeah,
right?
we can't give away all the sauce.
Yeah, we'd have to end the live.
Yeah, we'd have to.
Yeah, what are you thinking?
So I think the real answer is going to be you want to know who's on the other side of your trade, right? As best as you possibly can. So many times you'll go into, let's say, a smaller cap stock. The implied move is going to be so much greater than the average move, and you say this might be expensive, but in reality, into that implied move might be baked in, let's say, inside information, right? Mm-hmm. And that's going to crush you in the long run. You're going to be getting picked off every single time. So one thing to keep in mind with these earnings trades are really try to understand who's on the other side of your trade. Another thing that I really like to look at is how has selling vol around this earnings event for this specific stock done historically.
Yeah, that's why we have that historical moves chart, right? It's like how's the straddle done? If you bought the straddle or sold the straddle, or the calls or the puts.
Right. Because we might find that, like, let's say, this specific company on average has a higher risk premium than, let's say, another, let's say, small cap stock.
So when we talk about, you really put emphasis on why we need to be aware of who could be on the other side of our trade. Who trades earnings? Who could actually be on the other side of our trade as we go out looking to provide liquidity?
So there's a lot of people that trade earnings. First off, we're gonna have your funds, right? We have a friend who says if a position gets more than 3% of their book, they are obligated. So he works for Scotiabank, I want to say, if I recall correctly.
I think it was, yeah.
So they're obligated to buy some puts or sell some calls against that position.
Yeah.
So
they're actually obligated to hedge it, right? And that's really interesting, right? Think about this. Imagine if you're an insurance company, and no matter what price you quote well, I guess it kind of actually is like this in insurance, but no matter what price you quote the owner of a car, they have to buy the insurance. They can't shop around. It's like, oh, you're driving, a 2000 Honda Civic. Well, your insurance is going to be $1,500 a month. You know what I mean? And they pretty much have to buy it. Well, we can come in, or the market says it's $1,500 a month for this car. We know it. We can come in and price it, knowing that the person on the other side would have to buy it, and find ones where it's overpriced and be selling those only, right? That's actually one of the people we'd love to sell to. Is if a fund was on the other side, we'd be actually really happy with selling it to them. Who else could there be?
Then you're going to have the retail punters, right? That's going to, we've seen so much data on this now where they actually make a majority of the single name equity options market.
Yeah, they represent something like 12 to 15% of the volume.
Yeah, and I think I saw an article by Zero Hedge. I don't know how legit it is, but it was like going up to like 20% on some single names. I couldn't believe it.
Unbelievable.
And some big names too, right? So, I think that ties back to why we saw, selling vol last quarter. Even though we weren't around for that one, to be so good.
Why do we love selling vol to the retail punter?
They are willing to overpay for their directional view, right? They want that leverage. So let's say, for example, Netflix has earnings tonight, which we are going to be selling vol around earnings for what it's worth. So let's say, for example, Netflix has earnings tonight, and everyone is bullish on this company, right? I have not looked at the numbers yet, but let's say everyone's bullish on this company. So they're going to come in, they're going to start buying these call options because they want that directional view, and so they're going to be willing to overpay in vol terms to get that directional exposure.
So you're basically saying they can't price the asset.
Right.
So we can come in, similar to the fund, right? Where it's different though. The fund doesn't really have much of a choice, but the retail guy just doesn't give a shit.
Right.
He comes in and is just like, stonk go up,
Yeah.
call. More or less.
There's a funny story with one of our friends where, he thought this company was going to go up 5%, right? And the implied move was, let's say, 40%, right? So buying that call option is really not, buying that call option or buying that put option is really not going to give you the exposure or the risk profile that you want.
So okay, well there's probably a few people on here, and obviously we're having a laugh about the retail punters here, but look, a lot of it comes from a space of not knowing that stuff's important. So maybe we can give some advice to someone who wants that directional exposure around earnings, up or down. What should they actually do?
Yeah, so the first thing is price the vol, right? See how much this company moves on average historically. See what the vol is being priced at. Is everyone else that buying options as well? Maybe that's a sign that the thing's overpriced. Then you got to price the stock, right? What do you think the fair value of this stock is after the earnings event? And that takes a lot of research, right? That takes a lot of research. And then once you get that, once you have that, if vol's cheap, buy a call, right? If vol's expensive, sell a put. If vol's fair value, maybe do a vertical spread, right? Where you're just getting delta at inception. What do you think
about like unbalanced flies, things like that around earnings?
Yeah, absolutely, right. If if you think there's a lot of, let's say, skew to the upside, and you want to take advantage of that, well, you can do a butterfly to the upside, and if the stock does go up, you get a very good risk reward profile.
Exactly. So why do we not do that?
We do it. Like we do.
It's pretty rare that we'll be like outright buying a call around earnings, things like that.
Oh, I see what you're saying. We usually
it's just our view's different.
Yeah,
I guess.
Our view's different, and we usually think vol's overpriced.
Yeah.
Right. So for that reason, we're very unlikely to come in and buy just outright call or put.
Cool. So break it down like off the top, right? What are we going to be looking for? Which kind of companies are we going to be trading this time? And Kyle had a really interesting question here. Kyle, thanks for the question. And also, if any of you watching have a question, feel free to drop it in the comment box. Towards the end, we'll move into like more of a Q&A type thing. Try to keep it focused on earnings for this live. We'll go into more stuff on tomorrow's live, for example. Kyle's basically asking, why are we confident about this earnings season? He's like, earnings hasn't really always worked out for me. Why this one?
Yeah. So, well, Kyle, we are, one of the main reasons is we have some excess capital in the book right now that we can deploy. So that's one of the reasons. The other reason is because of this whole inflow of retail traders. We think it's going to be a great season, and just from last season, seeing that Stroud's lost 70 or 75% of the
Was that around earnings, or was that just in general?
Just earnings. 70-75% of their value was lost, and so it makes so much sense.
Won't we have a lot more people coming in providing liquidity though?
That's a really good question. I still think the imbalance is going to be there. So selling vol around earnings is difficult, right? The moves can be huge, the swings can be huge.
Yeah.
A lot of retail traders can't do that, right? You can have dealers come in and do that, but a lot of the times they don't want that on their books, right? And so for that reason, I think there's still going to be an opportunity, and this is like a structural inefficiency, right? I wouldn't say inefficiency; it's a structural risk premium that's going to be there. I think it's going to be there for a long time, right? Once it starts drying away, once it starts drying up, it's going to vanish. Once it starts drying up, the people who are providing that liquidity are going to vanish. There's going to be no point of them being in the market, right? It's too much risk for a single day. So for that reason, I think it's still going to be there.
Yeah. And that's kind of
this
like for people in maybe with small, medium sized, even like somewhat big accounts, that's actually one of the advantages. People who don't have a risk manager, basically, if you can embrace those swings, there's alpha. Right? There is alpha in doing this, but your P&L isn't going to be a nice, smooth, straight line up and to the right. Right? You're going to have to embrace the volatility.
Yeah, 100%. You can just, if you guys want to just shoot Kyle a message, he can tell you about that volatility, right? We've seen some big swings, throughout our time.
How long have you been trading earnings?
I started trading earnings maybe 2018 was when I really started getting into it. I used to trade earnings with one of my friends, Palumi.
Yeah.
We used to spend a lot of time on it. So yeah, I definitely have my battle wounds from trading earnings, but also has some great runs.
Nice. Kyle saying his risk manager is Pranav. Instantly regretted bringing him on.
You're one of the soup kitchen, bud. Where is Pranav? He's not here today.
I know. I would have thought Pranav would have loved this live, man. He would have had some good questions. But yeah, we're gonna, see if there's anything that we've missed. Just think about that for a second. But we're gonna move more or less into a Q&A right now.
Yeah, I saw Lauren T.
Oh yeah, Laurent.
Laurent. They had a really good question about buying volatility going into the ER event. Are you still around, Laurent?
Oh, okay. He was asking actually about trading earnings pre-event.
Yes.
Right? What do you think about going long volatility on the run-up and closing on the earnings release day?
Yes. So this is a really big misconception in the retail space. This thing called the IV ramp. Okay? Mm-hmm. It's very well known, right? And people think, you know what? I can just come in, buy vol, carry this position, and then as implied volatility increases, as it always does, going into the earnings event, I can make money holding these options.
Yeah.
Now, the issue is that IV ramp that we see is actually an illusion. Okay, it's what's actually happening is as we're getting closer to the earnings date, the earnings event volatility is taking up more and more of the actual option price.
Yeah, like really simply, like imagine we had a 100-day option that saw an earnings event, and that earnings event had a 20% move.
Yeah.
But every other day has a 0.5% move. Well, the IV of it's going to be like, 40, 50.
Yeah.
But now let's say that earnings event was right at the end of it, and now we have a 1-day option. Right? The option has decayed, and now there's 1 day. Well, the implied volatility for that option now, since it's only seeing the earnings event, is going to be like 300, right? Or like 350.
It's going to be some big number.
Right? But the option hasn't changed. It's still incorporating the same exposures, right? And Palumi's here.
Hey, Palumi, man. I was just talking about you. about our earnings season that we did in, 2018, 2019 when we went on that crazy run?
Nice. So yeah, if you have anything else to add to that, about the IV ramp, and then also we're not saying that there isn't a trade there, right? There is a trade pre-earnings.
Yes, but what you need to do though is you need to price what the implied move is currently, okay, what the non-event vol is currently, and you can isolate those through calendar spreads. But let's just say you want to do a straddle. You can figure out what is the implied move right now, what is the implied move today, and then what do you think the implied move will be before the earnings event. Right? You might think that, I can buy the implied move today at 3% because on average, Netflix has about a 7% implied move. Right? Now, obviously, you're almost never going to see that kind of edge, but you might be able to get, a couple points in there. And that being said, sometimes it's on the flip side. Sometimes the event might be overpriced, right? For example, 3 weeks ago, the implied move for Tesla, right? What the options were implying for Tesla was 14% for the earnings event, and that was because of the S&P,
inclusion.
So, and now it's back down, I think, to 9 or 10%, which is
still, it is. It's still huge.
Sure, you're getting the IV ramp, but you're actually losing money because that implied move is decaying.
Right. Just to build on that, Laurent, you noticing a bit of a pattern here with everything we're talking about. You need to be able to price the asset, right? It's always about what is this thing being what is the market saying fair value is? What do we think fair value is, and why? Right? Do we have a good reason for this view that we're creating? And this is basically the fundamentals of of what trading is all about, right? It's basically people looking at something, sitting across the table from each other, looking at an event or looking at an asset. One person says it's worth $5, the other person says it's worth $10. If that can happen, and they both are confident in their reasoning, a trade can happen, and whoever's more right makes money, or whoever's right more often, I guess.
Exactly.
Right, so we always need to keep that in mind, right? And that answers a whole bunch of questions as to why would a firm pay for a Bloomberg terminal, right? I saw the stupidest comment. You remember what our buddy shared in the chat? Yo, Bloomberg. Well, I've used a Bloomberg. Bloomberg ain't that great. It just gets you news faster and shit.
Yeah.
Are you kidding me? The whole point of a Bloomberg is to help you price these assets better, to find inefficiencies, right? Build out a strategy that maybe actually generates some alpha in the long run, right? It's really hard to see in the short run, but that's basically what it would be.
Exactly. I mean, it's the Bloomberg can offer so much value, right? It can offer a lot of data, also a great network.
True. Yeah.
So it is very good, worth the money. Pranav, welcome, Pranav. Great to see you out here.
Pranav, you missed a great conversation, man.
We were talking about you.
Yeah, Laurent's isn't Bloomberg Terminal just a Twitter for boomers?
It
kind of is. There's a lot of boomers that use it.
Yeah, definitely. But I think there is a lot of value there. I use one personally, and it just provides a ton of value.
Yeah, right.
Yeah, it's really where a lot of the early earnings analysis, we have Palumi on the live here as well. That's where a lot of the early days earning analysis before predicting alpha was really was born from.
Makes sense. Pranav, what's going on, man? You got any questions for us? We're talking about earnings.
Yeah, does anyone have any questions? Well,
Laurent saying Twitter plus the PA console greater than Bloomberg. Laurent, we don't even need Twitter, man. We got our own little Discord. Does that mean the PA terminal will be a Twitter for millennials and Gen Z? I was actually thinking about saying that. It's predicting alpha terminal is like Twitter for the E generation. Very cool. So yeah, we're gonna move into a Q&A here, guys. Do you have any questions about earnings events? Maybe one last thing to talk about is actually executing on earnings trades. So let's talk about two things. When do you enter? Let's say you find an earnings trade you want to take. When do you enter? What sort of trade structures should you be using to express a view on it? And when do you actually exit these positions?
Yeah.
Right?
So
the execution of this trade and getting fills.
Yeah. So, obviously you can always improve, right? You can always find new things in the market. For example, maybe there's more post-earnings announcement drift on let's say, tech stocks, or maybe stocks that release in the morning, have more announcement drift, right? You want to close them out earlier in the morning. So there's always, small edges you can find around there to improve your strategy. That being said, you want to be really, if you just want to provide liquidity and you want to, sell vol to these extremely hyped up names, you want to, I think, keep it simple, right? Don't get fancy with it. Don't start drawing lines on your charts in the morning. Sell vol near the end of the day, buy it back in the morning or in the afternoon. Don't get too fancy with it, right? That's what I would say. Sell the straddle, sell a 40, a delta strangle. Keep it simple.
Yeah. Don't go crazy with it. And then I guess also just something we emphasized before, but we have a whole bunch of new viewers, is the edge is small, right? Trading earnings events, there's not, you're not going to have a 90% win rate. This isn't scalping pips on Forex. No 90% win rate with a 500 to 1 leverage. You are taking on risk here. There are going to be swings. So what you need to do is you need to play small, and you need to spread it across a lot of different events. What's funny?
Kyle, he's really starting to get into the double diagonals, and he's really taking advantage of them.
Oh yeah.
So
he's like, I think the stock's gonna go up, double diagonal.
Yeah. Across 6 different expiries. It's like a triple diagonal he's been trading.
Oh God. Good stuff, Kyle.
Yeah. Something actually I also want to mention regarding earnings. You'll see this all the time. This stock had such a good report. Why didn't my stock go up?
Yeah.
Right.
Huge thing to talk about.
It's crushed earnings. It beat earnings surprise. It had a great earnings surprise. Why did my stock go down?
Yeah.
And I think it's really important to understand that a lot of this stuff's already priced in, right? There's a lot of studies, for example, where CEOs will actually bias their earnings low, their guidance low,
to look good,
so that they can come up over top, right? So this is already going to be priced in, and you can actually quickly see this by if you look at Apple earnings surprise, they almost surprise every single quarter to the upside, right? So that stuff is usually baked in. And the other thing is there's other stuff that happens in the company that also impacts where the stock might go. Like, for example, future guidance, right? If Apple comes out and says, hey, we had the best quarter ever, but next year we're going to be declining in revenues, right? Well, that's really going to drop the price down. So just keep that in mind, right? There's a lot of factors that go into these earnings events, and and the market's pretty damn efficient, right? You have, let's say, 10 analysts looking at, or not 10, I want to say 50 analysts and a whole bunch of at-home traders and pension funds and hedge funds looking at Apple, right? And trying to price their earnings, right? It's a lot of that is going to be priced very efficiently. So keep that in mind.
Really good stuff. Okay, guys, we're going to be wrapping up this earnings conversation here. A lot of what we're going to be talking about on the live stream for the next couple weeks is going to be earnings. We are going to be keeping a live trade journal of the trades that we break down. Every day I'll be going over the ones that we're looking at. Every morning we'll report on how they did, show the trade journal. So it should be pretty fun. If anyone wants to tag along for that journey, we'll be doing this every morning at 10:30 a.m. And guys, make sure to leave a like on this video if you got some value out of this. It's just a little thing you can do to help us out. I'm talking to you, Pranav. Leave that damn like on the video. I know you're that one guy who always dislikes it. We got one more question here. Kyle's asking about why are we doing half straddles for the account.
Yeah, and just before we get to that, Kyle, I also want to say, Plumi, if you can pull up that old scanner that we built out way back in the day, like we built out like our first earnings scanner. It was pretty awesome, and we used that for maybe like 6 months to a year. Can you post a screenshot of that, Plumi, in the Discord, please, just to show the guys, where it all started.
Like.
Yeah,
back in the day.
Okay, Kyle's saying why half lots. So, Kyle, we're not going to be buying wings here, so we need to scale down. We will buy wings if, let's say, for margin purposes. So, let's say, for example, we want to put on 5 earnings trades today. Well, if we go naked on 5 trades, that's going to eat up so much buying power. So what we're going to have to do is we're going to have to buy these wings just to cut down the buying power. That being said, we're doing half lots, Kyle, because the account is small. Right? I can't, if let's say we're doing it on a $20,000 account, I can't be trading a full lot on Netflix, right? A 4 standard deviation move is going to kill me.
Yeah, wipe out the account.
Right? So I'm going to have to cut that down, and so that I can, place the trade.
And just for the people who are probably like, what the hell is a half lot?
Yeah.
What the hell is a half lot?
What the hell is a half lot? A half lot is you sell a call, and then you buy 50 shares.
Mm-hmm.
Right? That's going to create...
Kyle's saying, isn't that also margin intensive, right? Having to put up all that capital for the shares.
Yeah. 100%, Kyle. That's a really good point. I don't know how it's in the States. I think it is the same, but like on Netflix, for example, IB will give me... all I have to put up is 25%. Right? So, sure, it's capital intensive, but it's a 1-day hold, right? It's a half-day hold. So, it's not going to kill me.
Okay, we're going to wrap up the live there. For everyone on this stream, every morning, 10:30, we do a half-hour sort of, power half-hour where we just go over, 4 or 5 trades for the day, break down what's happening from a data-driven perspective. So if you want, a few ideas for the day to see what we're looking at, make sure to tune in, right? We're going to be here Monday to Friday, 10:30 a.m. Eastern Standard. So thanks a lot for tuning in. Make sure to leave a like, subscribe. It helps us out and allows us to keep doing this stuff for you. So Take it easy, everyone. We'll see you on the
guys.
next one.